the comparison between universal life policies and traditional savings and investment accounts is flawed.
Most people in their 20s are focused on making money, but not enough are learning how to grow it the smart way. An IUL or an index universal life policy lets your money compound and grow tax-free.
Man, you are off to such a good start. Like, yeah, people in their 20s should invest a little bit more. IUL doesn't make sense. It's like, you know what? Hold on. I jumped the gun a little too fast. Let's hear him out.
Meaning you keep every dollar your money earns. While traditional savings and investments get hit with taxes and market losses, an IUL protects your cash from risk and still lets you benefit from market growth. Over
time out. Red card. VAR verdict, red card. Let me explain why. One, the comparison between universal life policies and traditional savings and investment accounts is flawed because these traditional accounts are tax sheltered. You're looking at, if I'm speaking to my Canadians, every TFSA, you're going to put after-tax cash, granted, but after-tax cash within this tax-free savings account, your wealth is going to compound over 40 plus years and the payout is going to be tax-free, right? In the United States, the same thing I just said about the TFSA occurs with the Roth IRA. Vice versa, if you're at a higher income bracket in the present, you may want to use the opposite accounts, right? The RRSP in Canada, or you want to use a 401k in the United States to defer tax in the present because for some reason you're at a very, very high tax bracket. Now with universal life policy, you don't get any of those. All right, you're contributing using after-tax dollars, right? If you are using an argument that insurance agents are going to say is that, well, if I have a corporate life insurance policy, I'm using pre-tax dollars to do so. That only gives you a cash flow benefit, but it's not an actual tax benefit because it's not a deduction on your corporate taxable income, which means that you're still paying tax on that amount. All right, so overall, the premiums that you're contributing are not tax deductible. So if we're comparing the premiums you're paying for a whole, like a life insurance policy versus just the straight up flat out after-tax contributions that you would put in a TFSA or a Roth IRA, you're better off with the Roth and the TFSA. You can borrow from those accounts all the same. So all three accounts allow you to borrow, but now you're not paying a premium for this amount. Now, I want to preface this. There's nothing wrong with life insurance. My issue is always with how it's marketed. Notice how the gentleman said, hey, if you contribute in this, you're not paying tax on it, like you're tax sheltered. That's not the case. It's technically correct, but the cash payout that's tax-free is once you pass away. So someone who's interpreting this piece of content is like, oh, I can use life insurance policies to defer tax right now, because as we all know, most people's issues with not paying taxes is right now. They're not thinking, oh, like when I pass away. Usually this happens when we're talking about estate planning. So we're talking about families, you already have kids and you're trying to pass on generational wealth. And that is when life insurance is so key. So there's nothing wrong with life insurance. There's an issue with how it's marketed. Another thing that insurance agents should be talking about that they don't talk about as much is the power and protection that life insurance has when it comes to creditors. If someone is suing you and pursuing you, life insurance payouts are going to be very, very hard to take from you. They could take your house, maybe. They could take your business, maybe. They could take any other asset you may have, but life insurance policies are going to be pain to acquire if you're suing somebody. So in terms of having tight-knit asset protection, life insurance policies are up there. Yet they don't talk about that. They try to talk about how it reduces people's taxes in the near term when it's not the case. And for that reason, the VAR verdict is a red card, man. I'm gonna have to hand that out. But if you guys want to see more content like this where we genuinely address and assess tax facts, tax advice, or just tax content in general, make sure to drop a comment, tag me in some videos you want me to react to. And once again, my name is Ronnie. It's been a pleasure, and I'll see you guys in the next video.